Hi, hello everyone. Okay, so today I'm going to explain to you what is business valuation, why do we need the business valuation, and definitely business valuation or company valuation, and what does it mean by startup valuation? Fine, and what are the methods we need to use the startup valuation, operational company valuation, fine, business valuation, fine. So the first of all, startup valuation always be used to get the funding from your near and dear ones. Fine. We will use that method, okay, to calculate the startup valuation. Even though you don't have the single day revenue, you need to calculate the valuation of that company, startup valuation, even though you don't have the single day revenue, but it has different methods to value the company. And why you need to calculate the value of the company? The reason is that normally it has been applied on the tech company normally. And for that point of view, you need the funding for that project. And who will give the funding? Your near and dear ones or your friends and family. Okay, there is no, other one who will give you the funding because it's a high risky project and you are going to test the idea. Secondly, for the business valuation or company valuation or operational company valuation, it means you are in the market for some years. And for that point of view, you need the funding and you're trying to, you know, induct or you're trying to involve in your business or you're trying to invite some investors who will come, who will see your business model, they will like it, their products and services, whatever the thing is there. Then based on that, they will say that, okay, they need the valuation. For that point of view, you will come to some kind of valuation company and you will get the valuation. Based on the, equity valuation, they will decide that, okay, 5% is equal to what amount they need to buy the equity of 5% of the company, 10% of the company, 15, 20. It's up to the valuation and the percentage and how, and it's also depends on you. Secondly, that transaction could be called as the buy and sell transaction. Might be you are trying to sell and some other buyer is want to buy. And sometimes it happens you as a seller, sorry for that. You as a seller want to sell the company and the other person want to buy the company. In that way, your, interest would be different. For that point of view, we need to calculate the average valuation method. And in that way, both the parties will come on such point where they will have the equal, equal interest. They would be on the same page. We need to calculate the value of the company, the operational company valuation. That would be based on three methods: asset base, DCF. So let me share the screen with you where you will get the idea that how the valuation, how many methods are there, and why, which methods we will use. There is scorecard method is there and checklist. This is totally, both methods are based on American approach. It means it's depend on the competency of the management, strength of the team, business model, okay, and so many other factors is there where we will calculate the scorecard method and checklist method for the startup valuation. Fine. You can see over here, scorecard method and checklist. Venture capital method, definitely, it's also a startup valuation. It includes pre-money valuation and post-money valuation. Fine. If you will see the DCF method with the long-term growth, DCF always would be calculated for those companies which have, which they are on a high stage. Fine. Let me tell you one thing. 1 minute. As I told you that regarding the method point of view, because Scorecard method I've explained to you, checklist method I've explained to you, because thereafter that I will go into the detail. Venture capital method, which is called the pre-money valuation and post-money valuation. It is always for the startup company. Normally, it could be a tech company. DCF method, I will explain to you. The DCF method is look like that if some kind of companies have a high growth companies, where we will need to apply the DCF method. The other is blended valuation. It means by combining all these valuation, that will be called the blended valuation. Fine. And if you will see some other methods like the market multiple or pricing multiple, that is P multiple, PB multiple, P multiple, price to book ratio, price to sales ratio, price to earning ratio, that would be called the pricing multiple. And these methods we will apply for the public companies, listed company. From there we will take the data and we will apply our subject private company to calculate the value of the company. Enterprise value multiple, it is always used for the full company, full private company valuation. But market multiple, price multiple, we will use for the minority interest valuation. Fine, this is the main differences there. Comparable company analysis and comparable transaction analysis, normally these kind of words you will use once you will do the merger acquisition transaction. Once you are going to acquire the company, then there is two methods we will use. Even though three methods you can say, comparable company analysis, comparable transaction analysis, and precedent transactions. Fine, three methods we will use. So comparable company analysis, we need to see, check the comparable companies. Comparable transaction analysis, whatever the actual by merger acquisition transaction has been done, we need to take that one. And the other is asset-based valuation. It is also called the private company valuation method, because the private company valuation method has three methods. The one is income method, which include DCF method, the free cash flow method. The second one is the market approach method, which is called the comparable company analysis. And the third one is the asset-based method. And apart from that, there is earning yields method as well. So concerning